Hey, this is John Hope Bryant, and this is the Money and Wealth podcast series for the Black Effect Network on iHeart Radio Network and podcast series globally. And this is the Money and Wealth conversation where we demystify finance and capitalism and free enterprise. We provide an environment for everybody to get the memo on how to come up from nothing and to grow wealth and opportunity. We demystify everything here. And this conversation is special for a number of reasons. One of which is this is the only guest I've had that is not a pre-existing relationship where I can talk mess to him and tease him, and he wouldn't mind it, but we just don't have that kind of rapport because I was so impressed with him when I met him in the Hamptons at a meeting of our friend Michael Milken at his home, I believe. I was so impressed with him on the first meeting. And within 5 minutes of conversation, probably 3 minutes with him and his wife, I just instantly asked if I could have him on my podcast. You'll understand why in a moment. And luckily, his wife said, yes, Alex, you should do this. Otherwise, I'm not sure he would. He's an understated guy. You're not going to probably know his name, but in a minute, you're going to know what he does by virtue of what he invests in and how he moves in the world. Meet Alex Roepers. He is the founder and chief executive officer of Atlantic Investment Management. Let me make it a correction. He's a founder and chief investment officer. And on Wall Street, the chief investment officer in a company like this is actually more important than the chief executive officer because the business that they're in is investment. That is the product. And he is the founder of this company. He founded it in 1988. 42 years of experience, 36 years as founder of Atlantic. He is a master of business administration at Harvard Business School, 1984. He also has degrees, including one from Netherlands School of Business, as in the Netherlands. And he is fluent in Dutch, German, and French, and finance. He is bilingual. He understands the language of money. And I will say, based on what he told me, he understands the language of finance, not just on Wall Street, but also on Main Street, on your street. He understands why you aren't learning, why you aren't getting this. Well, he can explain. He actually is a little befuddled why we don't understand, because this is something that literally helps to run the world. Alex, you're a pretty cool guy. I know because I read people very well. And it's one of my few gifts. And do you remember the conversation that we had in the Hamptons that stumped me?
Yeah, no, I do. It was part of a panel for the Mike Milken Hampton Dialogues with the title Finance as a Force for Good. First of all, thanks for having me and great to be with you.
Well, I'm honored to have you with me. I'm honored to have met you through Michael Milken, and I love the way you lead. I don't just love your cool house. It's exactly my style, or your very cool wife, who is got a wonderful soul and spirit. I loved your energy and soul and spirit, but I really loved our conversation. Not just because you were normal and being in the world of finance and high finance. Some people are just arrogant, they're obnoxious, they're self-absorbed, they're in a different world because I think they're uncomfortable in their own skin. That's a whole different podcast on spirituality we're not going to do today. But somehow you became reasonably comfortable in your own skin. Maybe we'll talk about that as it relates to sort of unpacking your background. But you and I had two separate conversations. One was briefly at your house, and another one was at a neighbor of yours' home. And you laid some philosophy about the world down to me. Do you remember that conversation? Do you remember the topic?
It was tied to the subject matter of the panel session that we had at my house in terms of education to the broader, public out there in terms of basic finance and basic running your household, but more importantly, saving for the future, and how important that is, and how that actually feathers right into investment management on Wall Street, and certainly the way at Atlantic Investment, and we go about picking our stocks. It's really at the household level of simplicity. People forget that when they buy a car or a dishwasher or a home, they do a ton of research. Actually, I do too. Why would you buy a dishwasher for $80,000 when you can buy it for $400? I'm saying this crazy number because when people buy stocks, they don't do the homework, and they just buy it because somebody told them it's a good idea or because it's going up, and they heard some key phrase like artificial intelligence, and therefore they should be involved and they should just buy it, and they just fail to do any analysis. But yet we all are value investors. When you're buying a car or dishwasher, you have a sense of what it should cost, and if you don't, you go on on the website, you go to a dealer or a retailer, and you figure out what these things go for. You take a look at them. In the end, you comparison shop, you become educated, and you can get educated in 1 minute or 10 minutes or an hour, depending on how much time you want to spend on it. And then you make a decision if you need one of these things based on the quality of the product and the price you're getting. This is the same way you should approach selecting stocks. If this is what you want to do with some of your money, if you want to be in the stock market, you can do it through an ETF, which is an exchange traded fund. Simple way of saying this is a daily actively traded vehicle that can capture the index or a sector that you're interested in. So you don't have to stock pick, you just kind of get broad exposure to an ETF. Or if you want to pick an individual stock, then you need to roll up your sleeves a little bit and take a look at what is the value and do a little more analysis. But that might be too much time and beyond the reach of a lot of people and the interest. So then an ETF kind of makes sense to get broad exposure to the market. But I do recall us talking about this area where you kind of bring it down to get basically educated and do your homework when you buy stuff you need for the home, for your life. And then once you have some savings, it certainly behooves you to put it in equities, in my view, because if you have a long-term view, the return on equities has been between 8 and 10% on the indexes over long periods of time with volatility, but that far exceeds the return you've been able to get on cash or on fixed income investments.
So I want to back up, and as we go through this, and you hit a little bit about the magic of what I want to talk about. We're going to explain as we go things that you never have to explain. We're going to explain what volatility means. We're going to explain what an index means. I mean, we shouldn't assume there's no home economics class anymore, Alex, in school. There are people who are highly sophisticated, advanced degrees, PhDs, master's degrees, white and black, Latino, women, higher, high, who have not a clue what we're talking about here because no one taught them, and they fake it. They don't admit that they don't understand how money works. A quarter of those who make $250,000 a year are living paycheck to paycheck. Half of those making $100,000 a year are living paycheck to paycheck. Of course, 70% of America is living paycheck to paycheck. But I'm getting ahead of myself. I want to come back to our conversation because what you just said just underscores that you're a decent human being. You're concerned about the least of these God's children. You understand that even though we were in the Hamptons where it's a very privileged, we'd all admit that's a very privileged environment. If you own a home there, you've been blessed with the American dream. And the fact that you can live in that world, still understand another world and have compassion for it and empathy for it, says a lot about you and your character and who you are. But that's the reason that you're on my podcast. Is I think you're a cool guy. It's not a smart one. But it's what you said to me when we talked. You explained to me in mathematical, numerical, statistical terms your business philosophy, your investment philosophy. Do you remember that conversation?
Yeah, I do. But prompt me more as to what you want to have me go into.
I want you to repeat exactly. Look, we make smart sexy on this podcast. Folks have been making dumb sexy for way too long. They dumbed down and celebrated it. We want to make smart sexy again. Even if folks will not understand maybe completely everything you're going to say, and I'll stop and reverse and after you finish, I may come back and ask you to explain a little bit of it. But I'd like for you to, don't handicap it. Don't put a varnish on it. Assume you're walking up to me again, or I'm walking up to you at a closed door meeting in the Hamptons or Manhattan or wherever, and you're explaining in very casual terms how you build a business. Do it exactly that way. Do not don't mince a word.
All right. Well, I'll try to recall the things we talked about, but maybe in a nutshell, I mean, you already gave that in your introduction. I came from the Netherlands, which is a very nice small country in Europe to grow up, but I wanted to definitely move out from there. This is in the late 70s when the country was quite socialist and tax rates were 60-70%, and a lot of young folks wanted to get out of there. My hope was to come to the United States, which I managed to do by applying to an MBA program. Applied to a variety of them, got lucky to get into a really good one. But I came across, remember, a one-way flight on a cheap airline, Finnair, with $2,000 in my pocket. Ended up in Binghamton, New York, on a snowy January 5th in 1981. I went to the car dealership and bought an Oldsmobile Starfire 1976. Was my pride and joy. And that gave me wheels, and I had a job which paid, okay, but just paid the bills for a cheap apartment. And that's how I got started, with a nice job with a company that was an industrial machinery maker that helped automate the manufacturing of what made computers and TVs tick, printed circuit boards. So anyway, a nice couple of years there. Went on to business school, and from there I was lucky to find employ in New York in the field that I wanted, which is in finance, and learned a bunch of things during the first 4 years in that job that made me come up with an idea to start Atlantic at a pretty early age. I was 28 at the time.
Wow.
I had a good salary in those years after business school, but nothing outrageous. Certainly didn't have any start capital for my business. Didn't have any investment capital from either family or friends. All I had was experience. 6 years at this point. 2 years before business school. 4 years after. I learned a few things about analyzing investments and companies in those years, and decide to take that toolbox, if you will, or the lessons I learned, formulate a specific investment strategy, which we still do to this day, which is a bottom-up, value analysis, kind of what I described earlier with your dishwasher in your car analysis. I don't know any other way to getting comfortable with an investment other than sticking to a known area. I don't go into areas you don't understand. In my case, all of technology, I don't understand it. I mean, I like to use technology products like we all do, but to invest in a company that sells technology, whether it's software or chips or high-tech products, I'm uncomfortable with it because I don't know how it will change and how that will affect the business. So I want to invest in companies that are very analyzable and understandable, that make products that we all use and that we see and can touch and have been around for a long time. And then you pick companies that are leaders in those areas, and then you wait until they're cheap enough. And so I decided to pick a strategy that is very comfortable for me in terms of competence and experience I've had, and also to avoid risk areas, not to go into areas like biotech and high tech, which for your audience, there's a lot of money to be made in these areas. I'm just personally uncomfortable with it. And I think if you invest in these areas, you have to, take that into account. And quite often it's better to go with very large companies that we all know, like Apple and Microsoft, which are very, very big names within the universe. But back to the approach that I started with, it was basically middle-sized industrial products and services companies where we could gain an edge by doing our investigation, our study, our review of these companies, meeting with managements, and then put together a selection of 10 or 15 names that we liked for our clients. And that's how Atlantic started, with that idea. And the idea was that through our stock picking and our focus, we could outperform, i.e. do better than the index. We need to, because if we don't, we have no right to exist. You can simply buy, my clients can buy, of course, the index, back to the exchange traded fund that anybody who's listening to this call, if you have some savings, you can buy an ETF, which is a way to participate in the US stock market and put that away.
What's an ETF, Alex?
Sorry?
What's an ETF?
An exchange traded fund. So it's like a stock. Mm-hmm. It's available, it's liquid, it has a symbol like SPY, SPY is the name of the spiders, they call them, is the S&P 500, which is the largest stock index that most pension funds use and many other players use just to get access and exposure to the US stock market.
So let's go back here, because I've introduced you in a very luminous terms, which are appropriate. You've gone to the best schools, all that kind of stuff, and came from the Netherlands and the Nordic region. And people might assume that you had a trust fund, you had inherited money. And what I heard is you came here on a cheap ticket. You had a few $1,000s, and you went and got some. The most important thing you got was an education. Is that right? So far?
Yep.
So you did not get a hookup, as we say in my neighborhood. You didn't have a trust fund. You didn't have daddy's money or grandpa's. It was just hustle. Correct. Number one.
Yep.
All right. You work for somebody else if you got your education to get some experience. And then you started your own investment house at 28 years old. Is that right?
Correct.
Okay. And that investment house, without getting too much into your business, is now several $100 million under management, correct?
Correct.
Okay. So you really built yourself literally up from nothing to become an American success story. Let's just say, again, without getting in his business, he has a $500 million under management in a company that he controls. No complicated management structure. He's the chief investment officer, and he's been running it since he was 28 years old. I get that right?
Correct.
All right. And it's a very simple business plan. Simple in the sense that you're very focused. So as I understand your investment philosophy, you've been known as your concentrated approach, your value-driven investment approach. Talk a little bit about how you developed this strategy and how it's evolved over years. And at some point during this interview, you're going to start, as we say in music, you're going to start rapping, riffing, and you're going to naturally go into that thing, say the thing you told me when I met you that blew me away, which was literally just a mathematical, statistical outline of how you go about really a science in investing that I thought was brilliant. But what is your approach, and how did you develop, and how has it evolved over time?
Well, the approach is to first define your investment universe. So I've decided to be just in public equity. There's many ways to invest. People can invest in real estate. People can invest in small or bigger companies if they have an opportunity. That's called private investing. So I'm only dealing with public investments. And then within public investments, I want reasonable liquidity. So I don't go for very small companies, but I also want access to management in order to talk to them about the business and to give suggestions where it makes sense. And so we focus in the $2 billion at the minimum to $20 billion size companies. These are very large numbers, of course, but within the public equity market, it's considered small to mid cap. Large cap is, much larger companies. As you know, Apple, Microsoft, they're north of $3 trillion market value. So we don't deal with these companies at all. Also, we like to focus on companies where we have an understanding of the business and where the risk factors of the business are reduced. And so we avoid, as I mentioned before, high tech and biotech because of the risk of what they call, difficult word, technological obsolescence risk, meaning that new products can come out that make the old products obsolete. We've seen so many technology changes, including everybody in the audience, I'm sure, will be very familiar with all the technological advancements we're all enjoying. Well, those things have tremendous impact on the profitability of a technology product that is being replaced or being made obsolete by the next invention. So we stay away from high tech and biotech for those reasons. That's just us. Many other people love to invest in those areas, not Atlantic. And then we stay away from areas where we find transparency to be an issue. And with all due respect to banks, there are many, many great banks out there you can also invest in, but we stay away from them because we find that the transparency of a bank is difficult to assess. And so we don't invest in the area. So now you have an idea of these areas. So $2 to $20 billion in size, enough liquidity, ability to access management with meetings, and stay away from certain risk areas. And within that, we want companies with good balance sheets. A balance sheet is at home, you have your assets, you have some cash, you have some things you bought, you have a house, hopefully, and then you have a mortgage that's a liability. So you look at the balance sheet. Companies have the same, if you will, with cash and property and receivables and payables, etc. And so we want good balance sheets. You can evaluate that. It doesn't take a degree to figure out what's a good and a bad balance sheet. It's a quick glance at what's publicly available to see if a company has affordable amount of debt, not too much debt. And so we make sure that our companies have good balance sheets and that they've always been profitable. One way to make sure of that is you look at a 10-year history of a company. Again, all of this is easily available online, and you can see if they ever lost money. Simple idea is, if you take a company that builds ships or does coal mining or is a pure chemical commodity company, they are very cyclical. Cyclical means that if the economy goes down, their revenues go down a lot and they'll probably lose money. And so we really are avoiding deep cyclical companies because we don't want a company that ever loses money. Even during a financial crash like 2008 or during the COVID disaster of the beginning of 2020. And so we look for solid, profitable companies in a familiar area that we can analyze, of a size that we can get our hands around it and meet with management to do further due diligence. And then we want to wait, very much like patient folks looking for a certain target. We wait until the share price falls down in our lap. We're basically tracking a whole bunch of companies. It's not that many. It's obviously in our field with our business, we have computer models, we have screens. Don't expect anybody to do that. You can be much more focused than we are even. But then you look for companies that you track for a while, that you watch the share price and what they say, and you look for them to fall in your lap, meaning they come to a price level, valuation level that is very, very attractive. That is typically the bottom where they trade. And now we're talking about valuation multiples. And I don't want to get too far into it, but ideally we buy something at 10 times earnings, okay, net earnings. That's a good guide for our kind of entry level purchase for a company. 10 times net earnings or 1 times revenues is about the area in which we are interested.
So let me break this down a little bit. So if the company had $1,000 of net earnings, net meaning minus the expenses and all of the overages that's tied to that particular enterprise. So net, the money that flows to the shareholders and the management team for the company, that is $1,000. You would buy it in that case for as much as $10,000. Is that right?
That is correct. 10
times net. Or in that particular case, that business might have $10,000 in revenue. So one times revenue, right? Is that right?
Correct.
And that's part of your due diligence. For those who are listening, due diligence means that he's basically going to do his research. They're going to unpack this company. They're going to peel the layers back. Transparency means he wants to be able to see through to the other side. He doesn't like Wall Street. Doesn't like fog. Doesn't like a lot of noise. They want to be able to be quiet and elegant and simple, and you can see through it. You don't want glasses that are all fogged up. It's not good to drive on a foggy day. Not fast. So you want to slow it down so you have clear view, transparency, to what you're looking at. And he talks about this stuff. By the way, this is all, he's being very basic. He's breaking this stuff down, but they talk about this stuff in such a language on Wall Street. People are people are intimidated to read the Wall Street Journal, for God's sakes, because it's all these terms that no one unpacks. So I wanted to slow down for a minute. Now, he mentioned he's waiting for things to fall in his lap, and I'm not going to mention this company's name, although listeners can probably figure this out. But today, a company that I believe is a good company, it's not a company he would track as too big market cap wise. They had a health situation that I think is episodic. In other words, it was something that dealt with the public, and they had an episode of a little bit of an outbreak, and the stock price dipped as a result of that. My sense was this was not the company's fault, that this was just something that could happen to any company. And my sense was it was going to happen once and it was done, one and done. It was just one of these unfortunate situations, a delivery truck or whatever brought something, and the stock dived. I bought it. So that fell in my lap. It's not the company. There's nothing wrong with the company. The company didn't do anything wrong. It's otherwise a great company, great brand. But I was able to get a 15% discount, I believe it was, because I bought it today. And that stock at some point will recover because the cash flows, the profit, the brand, the company itself is very strong. So I wanted to just sort of give people a bit of summary wrap of what some of what you just said. And when the one thing that I think people will find fascinating, Alex, is that you say you talk to management. Now, when people listening to this, or the average American or the average citizen, wherever they're watching this in the world, they're thinking about going to the manager at the retail store or the grocery store, and they can't get by the retail clerk. They're trying to get to the manager or supervisor to have a conversation. That person is blocking them. When you're talking about management, they might find it fascinating to hear that you literally pick up the phone and call the chief executive officer, chief financial officer, maybe a board member or two of the whole enterprise, and you're able to get these people on the phone because they want your investment dollars. Is that right?
Correct, but we're very respectful of other people's time. So unless we are seriously interested to be a large investor in that company, we will first go as a known institutional investor in the market to the investor relation person, and I'll have my analyst talk to the investor relation person. Once we get up to a certain level of comfort and conviction through our due diligence, and back to your unpacking of that word, due diligence is everybody on this podcast is doing due diligence. It's just a fancy Wall Street word for doing your homework.
That's right.
Checking things out.
Right.
You all do that. Looking at your purchase of anything you're doing, you check things out, compare prices on the shelf. So whatever you're doing, that's due diligence. Going to the store, kicking the tires. But anyway, we get these conversations because we've been in business for a long time. We're respectful. We go first to the investor relations side. And once we are in a position to make this a large investment for us, we will request for a meeting, first a call, then a meeting with the CFO. And yes, we meet with CEOs as well. But again, we don't want to do that unless we are a sizable investor potentially. And also that's one of the reasons we don't want to go above a certain size, which is in our case 20 billion. I'm not going to call up Tim Cook from Apple. I have no chance to ever get a meeting with him, frankly, because it's a huge company and we're never going to be any size investor in Apple. So we want to stay with these companies where we have a chance to meet with top management. For a normal retail investor, for anybody on the podcast, you're not going to get these conversations, with a CEO or a CFO of a public company, but you don't need to. You can do a lot of your homework, a lot of your due diligence by yourself with your friends. Maybe you make a little investment group and educate yourself and bring in occasionally a podcast like this or a friend who is in the business to have a chat, to have an hour-long conversation about stocks or the investment world in general. And so that I would suggest. But you can do a lot on your own, looking online, typing in the name of a company you're interested in, or the one that you mentioned, which a lot of people will know if you would mention it. I guess we're not getting into it. Right. That's a perfect example. We all know this company. It's a great company, and something unfortunate happened. They'll iron it out, and I'm very convinced that this particular air pocket, you want to call that, where the stock falls like this,
Right.
will be corrected over time if it is indeed a one-off situation, which I think you're right in your assessment. But that's the kind of thing where everybody in this podcast can pick a number of companies where they are customers in their daily life, where they know the company, they're interested in the company. Maybe it's 5 or 10 that you track a little bit. And you'll find, like yesterday, like, wow, if this is one of them, look at that, 15% discount. Just like somebody on the corner saying, this dishwasher you've been looking at for half a year, suddenly we're having a 20% off sale.
Right.
You rush over, you buy it, right?
Right.
Same with stocks. No difference.
That's right. And he mentioned another phrase, folks. He mentioned conviction. That what that translates is, unless I know I'm really serious. And in other words, I've been dating you. I met you on a dating app. We were dating. You're cute. You know, you're fine. And we've had a good time. But I'm not sure I want to marry you. But if I propose to you, if I give you a wedding ring, an engagement ring, and we set a date, well, I've got conviction. And yes, I may not get to the maybe something might happen. 2% of the time you don't get to through the ceremony because something weird happens. But most times when you get to that point and you've got an engagement ring and you've got a date, there's a lot of conviction there. You told the family, everybody's all invested in this thing. You have a comfort. So when he's comfortable, when he's got that level of conviction, then he might go beyond the investor relations person. Now, I'm going to tell you each a little bit of a secret here. And he wouldn't even, Alex is so sophisticated in the way he operates. He wouldn't think about this, but I'm sure he would agree with it. If you want to have some fun with your kids at Christmas, about 2 months before Christmas, go and try and buy one share of stock and get one of these companies that give you certificates, and they'll frame them for you and send it to you. The companies that do that, these companies don't do physical share certificates anymore, most of them. But you can get a company that send you a certificate. I have one, and put it on the wall. Give your kid a share of stock for Christmas. But anyway, the point of that is, once you own one share of stock of any publicly traded company, when he talk about public equities, he meant publicly traded company. When you have one share of stock, you have the rights to all their financials. Hello. So you get to look under their hood of any company that's publicly traded with only one share of stock. Now, the investor relations, if you want to, I shouldn't tell you this, but because I don't want anybody writing letters to boards of members and the board of directors. You get upset with some company, you have a real serious issue now. I'm not talking about suing them. You just want them to know that they could do better. And you can't find the board of directors anywhere. You can't find the management level either. It's some big retail company. Just go down on the website to investor relations. It's investor something, right? When you go there and you open that up, my God, it's like opening the hood of a Ferrari, right? Everything's in there, including the board and their most recent financial reports. So I just wanted to, so he goes and deals with the investor relations department out of respect. And he only goes one step further if he's got conviction. Did I get that right, Alex?
It's 100% correct. And again, it goes back to what is in your personal life. We went to the dishwasher example, but you went to the girlfriend, engagement, wife example. One needs to, in any development in life, develop conviction that the decision you're going to make is the right one, and there's no shortcut to doing your homework. And it's just time and effort. And depending on how big the decision or how big the purchase is, if it's something material, the more you need to roll up your sleeves. If you have a t-shirt on, you just leave it the way it is, but you get busy.
That's
and
right.
You talk to people, and you walk around blocks, and you go to stores, or you, in the case of a personal situation, you talk to more people, spend more time together, you talk to their friends, meet the family, etc., all the obvious stuff.
And when I first started investing, I would just buy what I liked. I liked Walmart. I'd buy Walmart. I liked whatever the company was. Whatever I was wearing, whatever I was using. I looked around my household, like, what am I using? What am I wearing? What do I trust? And Apple's an easy one. We already talked about Tim Cook. I'd buy Apple stock, whatever it is. If I liked it, my friends like it, and we're comfortable with it, probably pretty good retail investment. And by the way, anybody listening to this, if you have a 401k plan, an investment account, if you work for somebody and they're matching your 401k, get as much of that as you can because that's free money, right? As Jay-Z would say, I'm gonna give you $1 million worth of advice for $9.99. This is no 99 because you're not paying a dime for it. But if your employer is matching your 401k, that is free money. Now, before we get on to, I'm going to run through the other questions pretty quickly because I want to make sure you have a chance to answer each one of them. But on this investment philosophy, which I think is so important, do you have a statistical, numeric? Is there a model that you use for your investment? Something you're willing to share?
We use, first to find the companies, we use pretty sophisticated screens that are available. Bloomberg is a well-known terminal we use for screening, but having done this for so long, we pretty much know all the targets. We have wake-up calls literally on prices and valuation levels that bring them to our attention. Once they come to our attention.
What's a wake-up call? I'm sorry.
Wake-up calls is, let's say, take a stock of a company that you just talked about, without the name, but that just fell down. Let's say the stock was at $100, went up to 110. You're interested, but you said, I'm really interested at $80. And so you put a price limit in your computer. You can just do this actually at home fairly quickly with various financial websites. And you can put a wake-up call. Let me know when the stock reaches 80. Right. And boom. So you don't have to watch the news all the time. You just look at your computer and I say, look at this. It's like putting a fishing line out and a little bell went off. I think there's a hook there. Let's start, yanking on that line and see what's on the other end of it. So that's it. So you do, the alerts are important. And then once we are alerted to a situation, we will roll up our sleeves, the good old homework and due diligence we talked about. And yes, we have financial models. So now we have taken and downloaded all the financials that you can get from the company website, from the financials in a Excel spreadsheet. So now it gets sophisticated. We do modeling. We make estimates as to where the business is likely to go. These estimates are determined based on our conversations with the management, with other people that know the company, with competitors. And then we come up with predictions. And based on the predictions and based on where the share price is, we have very set discipline as to what valuation level we're willing to buy this. Back to the example you used earlier. Let's make it a restaurant. Everybody can relate to a restaurant. Let's say in the neighborhood, a restaurant that around the corner becomes available for sale. Let's say they do $1 million in revenues a year and they make $100,000 in profit.
Right.
And they say it's available, and maybe you don't have the money, but maybe a group of you are interested in buying into it because it's such a great place. You all go there anyway, and maybe you can run it better. And say, okay, how much does the seller, the restaurant owner, want for this? Let's say he says $20 million. He said, you got to be out of your mind. That's 20 times revenues. That is 200 times earnings. It's crazy. So go away.
So this is a great example. Everybody listen now. Listen. He just gave you, by the way, everybody's in the private equity business. If you're investing in your cousin's nail salon for $500, that's private equity, right? So he's just doing it at a much sophisticated, much higher level. So if somebody's coming to you and they want to sell you a business or invest in a business, he just gave you a formula. And he told you what's ridiculous and what's crazy when it falls outside of that box. He told you no more than 10 times net revenue or
net profit. Net income. Sorry, net income.
Is it net income or net? I want to make sure it's your
10 times net income and maybe 1 times revenue is a good measure for a pretty stable, nice business. We're not talking about a high growth business. We're talking about a restaurant business that is good, solid, has been around. And if they offer you that for sale for like $1 million, that's reasonable. Now we can talk about it. They say $20 million, it's a joke. $5 million is a joke. The funny thing is, in the stock market, people are buying things that are based on what their friends told them at a barbecue or what they've heard on TV as something great about technology or artificial intelligence, and they just buy it. I mean, to put it in perspective, the greatest company everybody talks about these days is NVIDIA, which makes the the plumbing for AI. The chips that everybody needs, that Microsoft, Apple, Amazon, Google, all these guys need it for their AI, artificial intelligence.
Right.
So NVIDIA is trading at $3.5 trillion, which is about 25 times revenues. Now, that's ridiculously expensive. I wouldn't touch it. But of course, it's done very well. And it continues to go up because more and more people want to buy it. And they do perform very, very well. But it is extremely expensive. And nothing can go wrong in terms of the growth slowing down or anything else. So that is, to me, speculative. And yet, it's one of the largest market caps in the world. If, in fact, it's number 2 right now behind Apple. And so I challenge, or I ask everybody, do your homework when it comes to stock market investing, as well as you do your homework when you buy a house, a car, or a dishwasher, or if you're offered an opportunity to invest in a nail salon or a restaurant around the corner. Compare it, the purchase price or whatever they're asking, or whatever the stock is trading at, against the total revenues and against the earnings that they have, and then assess if this makes any sense to you.
So one thing that I'm going to push back on Alex, and he won't mind it because he has no self-esteem problem. What is Alex already knows, one of the reasons why people are goo goo gaga about NVIDIA and why it doesn't make any sense on the numbers is, at the moment, they're perceived to be the primary backbone. He already said it, for artificial intelligence, which is the new de jour. Sexy investment and opportunity for the next 5 years. And it's not 20 of them. It's not 100 of them. It's not a restaurant around the corner. It's not a nail salon around the corner. There's not even an attorney. There's hundreds of attorneys, hundreds of thousands of attorneys, law firms. It's one of these. So you can decide whether you want to invest in it or not, but that's why there's a lot of hype around this particular investment, which is why he calls it speculative, which is correct. Bitcoin could be cryptocurrency could be the same kind of conversation. You can get lucky with a Bitcoin, but you might get unlucky with the thousands of other cryptocurrencies, which are completely speculative. So just, again, comes back to do your homework. I've explained about Alex being this very successful guy, and he's got this beautiful home I was in. He doesn't spend time in most of those rooms of his house, as I don't either. We spend a lot of time in one room, our office, and it's late in the day in Manhattan. He's in his office. He's not at. I don't know what your perception is of successful people. Look at that desk behind him. For those who are watching this on video, after you listen to it on audio, and if you listen to it on audio, go and watch this clip also on video. Behind his desk is nothing but papers, documents, stacks of analysis, and best I can tell, there's highlight marks on the different reports, if I'm seeing this properly. And there's a pen that's yours. There's a newspaper. There's a Wall Street Journal. You're looking at the market for today. There's a remote for the TV. You're looking at CNBC or Bloomberg or whoever to see what's going on in the markets. In other words, this guy's not relying on other people and sitting around drinking cocktails, whatever your perception is of highly successful people. This guy is hustling. He's working. Do I have that right, Alex? Were you working today?
I think so. You got it right. Absolutely.
So those documents behind you, that's not your assistant. That's not your chief of staff. That's your desk. Isn't that right?
That's correct. And I'm looking at a whole bunch of screens on this side, including the one you and I are talking on. And when we're done, I turn around and go back to my reports that I'm reading on companies, cash flow models, and papers, etc.
So you don't trust anybody else to do that analysis when you're investing hundreds of millions of dollars or even tens of millions. You make sure, as chief investment officer and as CEO, you do it yourself. Is that right?
Correct. Yep.
So let's now cut to the current situation, the current environment. There's political, socio instability and change and environmental, and the world's going, we perceive, bonkers these days a little bit. But what's your view on the current economic environment, and what's your advice for aspiring investors on opportunities, if you want to call it that, broadly defined, for the future?
No, I think, first of all, we're all very lucky to live in the United States of America, number one. It's a democracy. It's a capitalistic society. It's the American dream. A lot of people want to come here. In fact, a lot more people want to come here than we can, vet at any given time. But I came here. I'm an immigrant, and I left, beautiful Europe, if you will. But also, I came here for opportunity. Many people do the same thing, and so we're all lucky to be in a country where you can educate yourself, you can work yourself up, even if you have modest means or very little means. You can really, there's a place everywhere for a job, for learning, and for advancing yourself. The key thing is be disciplined, be focused, try to avoid taking on debt where you can. First pay down debt as much as you can, and then try to save, and always try to put some money away. When you get going and things are going well, always save it. The sooner the better. The younger you are, the better. And if you work hard and you get the controllable variables right. So what is a controllable variable? You can't control what the weather will be like. You can't control what all the others will do. What you can control is what you can do. You can be on time, you can be reliable, you can be trustworthy, you can be hardworking. These are the things you can control. Always control them. Don't mess up. Don't, be reliable 90% of the time. Be reliable 100% of the time. The example I use is when somebody comes for an interview in a nice white shirt, and there's a pizza stain right here. It will be where the eye of the potential employer will go. Even though 99.9% of your shirt is perfectly white, there's a pizza stain, and you kind of wonder, the employer wonders, like, why didn't you remove that, or why didn't you change your shirt before you got here? Same with the typo in your resume. These are controllable variables. You need to get that stuff right. Spend the extra time to review stuff, to be on time. And once you have a job, be on time, be reliable, work hard, do the right thing, and be patient. It takes 3 years to get 3 years of experience. It sounds very obvious, but people, particularly in this generation, think they want it all right now. And it takes a while. If you look at my business, started at 28. The first 3 years, I didn't do very well at all. I had to borrow money from my brother after 3 years in business to pay the rent. He charged me 10%. Very nice of him.
Your brother. I love it.
Well, mind you, at the time, interest rates were about 8%. So he figured he needed to charge a premium. If it was junk debt, Mike Milken might relate to that. Exactly. So I borrowed 10 grand, and this is now I'm 31. I got my MBA. I've been working for other people, and obviously spent whatever savings I had on the first 2 or 3 years to keep my business going. And the business didn't go well. I had setbacks, and I just stayed with it. And persistence, if you stay with something that makes sense, whether it's a job or a new business that you're trying, if you know it makes sense, and you didn't get the breaks you wanted or the tailwind that you were looking for, stay with it. Keep at it. I mean, I'm certainly an example of that, where 10 years into it, finally things started to go my way. And even then you got to watch it. So stay paranoid, meaning have the fear of failure as an entrepreneur. Always have the fear of failure. That will keep you from falling into the complacency trap. Never get complacent. Right. Unless you step out of the game. Then step out, and if you've achieved everything you wanted and you want to just play golf or sit on a bench or go for walks, that's fine too, but then you can be complacent. But if you're live, meaning like we're live on this podcast, if you're live in a business or in a career, never get complacent. Always have the fear of failure. Be 100% reliable, 100% on time. And these are the controllable variables. Then you can still have setbacks. But you can also put yourself with that in a position to suddenly reap the benefits of your experience, your patience, to make some real good progress and money when the tide turns your way.
So I want people, as we wrap this up, I want the audience to listen very carefully, rewind this, and listen to the last 20 minutes of this podcast in particular. I really want you to get into this, and I want you to remember what he just said. Now, controllable variables are things that are within your, obviously, control. I would say that this way. Most success is tied to good habits and execution. Good habits and execution. Execution means doing things. Good habits is having a set of standards about things that are consistent and do that consistently over time, which is another way of what he just said. My wife Shacher would say that most behavior is learned behavior. So you want to be nosy about everything, but certainly the right things. When Alex and I met, one thing was obvious about both of us. We not talked about any of this, by the way, beforehand. We were both nosy. I mean, God gave you 2 ears and 1 mouth. You listen twice as much as you talk. I was nosy about his business in his life. He was nosy about my business in his life. He was so nosy about inclusive economics, inclusive capitalism. We hosted the meeting in his house. That's how nosy he was. And he didn't host a meeting and leave. He hosted a meeting and sat in the audience with a notepad to take notes because he wanted to learn. Who knows whether he's going to end up investing in a business that may be tied to an underserved neighborhood or community. They're huge market opportunity, but whatever his reason was, he was just passionate about education. It's something else I want you to notice. Notice how he's dressed. Now, again, I'm not going to get into his business about his net worth. It's none of your business either. Let me just say this. My man has done very well for himself. He's very comfortable. Now, if he walked down the street, you would never know it. He's got we didn't talk about this. We can talk about our wardrobe. My guess is how he dresses every day. He's got a powder blue shirt, maybe light gray, light blue. He's got it buttoned up to the second button. He probably has no fancy jewelry on, no watch or anything. I'm sure he doesn't have any fancy rings or that stuff on. Let me see your hands, Alex. I'm just curious. Let me see your hands.
All right, I do have a watch on. Okay, here we go.
No, it's a beautiful watch, but nothing simple. He's got his wedding ring on. What's the other hand? On the other hand?
This is a Oro ring. This is actually no commercial here, but it's a ring for
health.
That's it.
Look at that. No jewelry, right? Now he's got nothing, and there's nothing. What he wants you to see him. He wants you to focus. If you're an investor, if you're thinking about coming in his office and giving him some of your money to invest, he doesn't want you focused on that other stuff. He wants you focused on him. He also doesn't want you to think that if you give him some money, that he's going to waste that money on stupid stuff. So it's a very simple method. So the creative class that's listening to this, you get paid for being loud. It's jewelry, it's sunglasses at night, it's brooches, it's fancy cars. I get it. But if you want to go from cashing the check to writing it, and you want to become from a consumer to an investor, or if you want a job if you just forget the creative, those are successful and creative, God bless you. But if you want to go to working at an investment house, don't walk in his office or anybody else's office with a lot of stuff on that distracts people from the one thing they're buying: your brilliance, your intellect, your good habits, the things he just mentioned. He wants to know you're going to be focused on his clients' advancement, period. It's very simple. Good habits executed over time. Alex, did I get any of that wrong?
No, you got it all right.
So let's wrap this up. Let me ask as a closing question. People are listening to this, that now they feel more successful. They feel more comfortable that they can approach somebody like you, that you're talking a language they understand, that you've demystified Wall Street and finance. And by the way, just for those who don't know, an investment house like Alex's is not FDIC insured like a bank would be. A bank is the only basically government-backed business in America, backed by the full faith and credit of the federal government. You don't care which bank you put the money in; it's guaranteed. What he's done is much more difficult, because he had to get private capital to invest in an investment house. 100% theoretically is at risk. And so what he's done is he's got to be very, very precise and very, very clear on the numbers, the KPIs, the key performance indicators, because he's going to be judged on everything. He can't afford a moment of mistake. So it's really great what he's built. As you're looking, Alex, at the future, 2025, 2026, people here listen, they become more comfortable. They feel like they know you a little bit. What advice do you have for them about, are there any last term we're gonna unpack today is it a bullish environment or a bearish environment? Can you please explain what that means? And if you believe it's an environment that's opportunistic, meaning there's opportunity in all the chaos, are there 2 or 3 or 4 categories, areas, industries that you encourage people to look at? And then I have one last question for you before we wrap.
Okay. So bullish means everything is looking positive, everything is looking up, the economy is good, therefore, the stock market may do well. Bearish is when people are very worried, they retrench, companies hire less people, people spend less money, the economy contracts, the earnings of the companies go down, and therefore the stock market goes down. So that's bearish versus bullish. I'm a bullish guy. I'm always optimistic pretty much all the time. So I'm looking at the next couple of years again with great optimism. Why? We have, fortunately, very low unemployment overall. Of course, there are pockets where it's difficult, as always, but in general, it's a pretty good environment. We have interest rates, which were high recently, but they're coming down as well. So that's positive. We've had a lot of uncertainties, and we continue to have some. But I think they will go and become less uncertain as time goes on. For instance, the U.S. presidential election, we'll have certainty on that soon. We'll have geopolitical issues that might bother people and all of us, that will suddenly be less of an issue. These things do resolve themselves over time. So I'm looking optimistic to 2025 and 26. Particular areas of interest, of course. There's a tremendous amount of excitement in the technology area, but again, buyer beware. Beware of what you pay for certain stocks in these areas. In general, I think there's going to be an upturn in housing and automotive from very low levels. We've seen, because of the higher interest rates and mortgage rates, a decline in existing home sales. People don't want to move from one home to the next, and therefore, if you don't move from one home to the next because you have a low mortgage rate that was locked in, and you don't want to make the move. So right now, existing home sales are as low as they were in the crash of 2008, 2009. If they pick up, you see a pickup in appliance sales, in paint, in carpets, in all the things that people do when they get a new house. They renovate it, they freshen it up, they make it look like their house. And so existing home sales are at the bottom. They're likely to move up as interest rates come down in the coming years. So those are areas of interest. And if I may,
and the companies that make paint, and the companies that make fences, and the company that make turf, and the companies that sell that stuff, those might be also moving up with them. Continue, Alex. Sorry.
Correct. So as a message to everybody on the podcast, I think as a maybe parting note, you're all about education and financial literacy. And I think everybody needs to take that to heart and do this at home as much as possible. Unfortunately, in school, they don't teach kids basic economics. And we're not talking about sophisticated stuff. We're talking about a checkbook, balancing your checkbook, credit card spending, mortgages, all these basic things. You can just type in the words, get simple educational information that you can discuss at the dinner table with everybody, with yourself, with your spouse, with your loved one, with your young kids. Talk about balance sheets. What is an asset? What's a liability? What's debt? What is a mortgage? How do we save money? How do we grow money? Give, if possible, your kids, when they're 12, 13, 14 years old, an account. Like, I'm not saying any particular, but E-Trade account, some account where you can buy stocks. And then for Christmas or birthdays or for whatever holiday you celebrate, give another $100 or $200 or whatever you can give to this account instead of another toy, and let them pick their own stocks, or let's discuss those stocks together. I've done it with my kids. And at one point, if you start at 12 or 13, maybe at age 25, 26, it could be a meaningful amount. And then you have your job as a young person, but you also have your savings account. You shouldn't touch that, and keep growing it. And as you said, your 401k, which you might get from the company, if they match it, maximize it for sure. And then make sure it's invested properly. And if you have choices, try to put it into equities. I think those are good points.
So I've never done this before. I'm honored when I get a chance to meet a guy like you who's so successful and so approachable. I have a book that's Financial Literacy for All, #1 best business finance in the country for the last 8 months. I'm gonna say to anybody watching this podcast, if you were inspired by Alex and you're wondering, like, I'll never meet a guy like this, like I'll never run into him on the street, I'll never run into him in the elevator, he's probably got security, whatever. I'll never be in the Hamptons. I just would love to spend 30 minutes with a guy like him and ask him questions and be inspired, and maybe even pitch him for an internship for me or my son or daughter or whatever. But I'd love to just have 30 minutes with this guy. I'm making a commitment for him that hopefully he won't hate me for. But if you write me a note, send it bill.fair, bill.fair at operationhope.org, my deputy chief of staff, and make a case for why you should have an audience with Alex and his firm, why you think that you are worth 30 minutes or 45 minutes of his time. The top 10 people for the letters I get, I'll give 9 of them a copy of my book, Financial Literacy for All, just to write in the letter, the top 10. And the #1 best one, I'm going to recommend to Alex that he actually meets with you for 30 to 45 minutes and give you an audience one-on-one, and hopefully that might inspire you to change the course of your life. Alex, would you mind doing that?
Not at all.
There we go.
My pleasure.
Closed mouths don't get fed, as they would say. And I knew he'd say that because Alex is a great guy. So we've gone over. Thanks for your time. Quick question. How'd you get so decent? It's a quick question. And I know it makes you uncomfortable. I know you're a humble guy, but like, you're just normal. Like, you're just a cool dude. How'd you get
parents, it's I think if the parents have good values and teach you all the controllable variables we just talked about earlier, that is something that stays with you from an early age. So lead by example. And my parents led by example, and hopefully I'm leading by example for my kids. I think picking your friends is important. If you're around 3 brilliant people or fun people, you're probably going to be the 4th one. If you're around 3 really not so good people that are slacking off and hanging out, you're probably going to be the 4th one. So pick your friends carefully. You can't pick your family. And if you don't have the values from home, try to get it from somewhere else. Get it from people that inspire you. Read books about people that were very successful. There's so many out there where people write memoirs or write about them. And read how these folks started and how they got somewhere. And you'll learn that most all of them recommended or did the things that we were talking about today, about the values and the variables you can control.
Amen. I tell you, Ambassador Andrew Young has a quote, Alex: "Coincidence is God's way of remaining anonymous." And you said something that you would never know. You would have no idea that makes you my brother. You said that if you hang around 4 or 5 successful people, you might become the 4th or the 5th one, right? 3rd, 4th, 5th one. I often say, if you hang around 9 broke people, you'll be the 10th. And those are the bookends of our lives. Watch who you hang around, watch what you do, watch your habits. These are your controllable variables, some of them. And as Michael Milken, our mutual friend who introduced us, would say, that we are all born with even or equal potential and equal intelligence for that, potential for that intelligence if you grow it, but not equal opportunity. Thank you, Alex, for being a beacon and a lighthouse for equal opportunity.
Thank you, John, and thanks to everybody for listening to the podcast, and it was my pleasure.
Ladies and gentlemen, this has been Money and Wealth with John Hope Bryant on the Black Effect Network and iHeart Radio, and you've been listening to Alex Roepers, who is the Chief Investment Officer, effectively the CEO in investment terms, of Atlantic Investment Management. Go change your life. It's all in your hands.